Since 1944, the US dollar has been the world's reserve currency. That one fact gives America more financial power than any military. It can print money to fund wars, impose devastating sanctions, and never worry about debt. Xi Jinping has studied this for 30 years, and now he has a plan to end it. In mechanical terms, the exorbitant privilege means the United States can pay for foreign goods using money it prints itself, while every other nation has to produce tangible exports to acquire those same dollars. China's political leadership, and specifically Xi Jinping, has spent decades observing how this singular advantage allows the U.S. to project authority across the globe. But neutralizing that leverage requires a structural workaround, not a kinetic war. China is actively bypassing the dollar by building an entirely separate financial architecture. The base layer of international influence is migrating from naval blockades and physical borders to cross-border settlement code. The mechanics of this dominance began at the 1944 Bretton Woods Conference, which formally pegged international currencies to the US dollar, cementing it as the global standard for trade. 30 years later, the 1974 Petrodollar agreement with Saudi Arabia locked this system into the energy market. By pricing all Saudi oil exports exclusively in dollars, a permanent global baseline was established. This created a self-sustaining cycle. Every nation requires oil to function. To buy oil, they require dollars, and to acquire dollars, they must export goods to the United States. This relentless structural demand for dollars allows the U.S. Treasury to run massive, continuous deficits. Where other economies would collapse under hyperinflation, the U.S. exports its inflation to the rest of the world. The architecture of global trade essentially forces foreign governments to finance American debt, subsidizing the U.S. economy simply to keep their own lights on. At the center of this architecture is SWIFT. Despite its reputation, SWIFT is not a vault that holds money. It is purely a messaging system that tells banks where to move capital. Because the vast majority of these messages involve dollars, the actual settlement relies on correspondent banking. If a bank in Brazil wants to send money to Japan, the funds must route through a clearing bank located in New York. The moment those funds touch a U.S. correspondent bank, the entire transaction legally falls under United States jurisdiction. Recent U.S. administrations recognized this routing necessity as a massive geopolitical weapon, aggressively revoking SWIFT access to instantly freeze adversarial economies out of global trade. By turning a neutral clearinghouse into a mechanism for sanctions, the U.S. Treasury alerted every other nation to a glaring vulnerability. The threat of being disconnected drove neutral countries to accelerate their search for a de-risked alternative. China initiated a dual-layered response. Domestically, they rolled out the digital Yuan, or e-CNY. Internationally, they launched CIPS, a specialized clearing network intended to process cross-border payments directly in renminbi. But CIPS has a critical structural flaw. Because it lacks a fully independent communication protocol, a significant portion of CIPS transactions still route through the SWIFT messaging network, leaving it exposed to U.S. oversight. To build a truly insulated system, China needed international partners. The recent expansion of the BRICS coalition provided exactly that geopolitical alignment. With the inclusion of major energy producers, this expanded bloc now controls a massive share of global oil production and commands a staggering portion of physical commodity trade. Historically, alternative payment systems failed because they lacked volume. Now a coalition exists with both the political motivation to evade American financial routing and the raw economic mass to sustain a parallel system. The technical solution to the corresponding banking problem is Project mBridge, a system quietly incubated with the Bank for International Settlements. By mid-2024, the initiative officially reached the minimum viable product stage, moving from a theoretical white paper to a functional deployment. mBridge uses an EVM-compatible distributed ledger, a blockchain handling multiple central bank digital currencies. The architecture connected UAE, Hong Kong, Thailand, and China nodes, with Saudi Arabia joining in 2024. This solves the SWIFT choke point, allowing instant peer-to-peer settlements without U.S. clearing banks. The ability to trade high-value commodities without touching the U.S. legal system is no longer a political aspiration. The code is written, deployed, and processing real-value transactions. The psychological impact of this infrastructure became obvious when Saudi Arabia signaled its willingness to accept Chinese yuan for oil exports, settling the trade via the Enbridge platform. Headlines immediately declared the end of the dollar. But the empirical data sitting on central bank balance sheets tells a vastly different story. We can see this in the IMF's Currency Composition of Official Foreign Exchange Reserves, or COFR, dataset. As of the third quarter of 2025, total global foreign exchange reserves amount to roughly $13 trillion. This pie chart visualizes the $13 trillion COFR dataset, breaking down official reserves by currency. It shows the US dollar maintaining an overwhelming 59% share. In stark contrast, the Chinese renminbi accounts for a minuscule 3%. The friction preventing the yuan from competing at scale is structural. Beijing maintains strict capital controls, heavily restricting the flow of money in and out of the country. Without free-flowing capital, China cannot generate the deep, highly liquid bond markets that global central banks require to store their wealth. The math proves that a total dollar collapse is a fiction. Unwinding a $13 trillion reserve position is a multi-decade structural glide path, constrained by hard economic limitations. The sheer depth of the dollar's liquidity moat guarantees it will remain the dominant global reserve asset for the next decade. However, the trajectory points toward a distinct reality by 2040. The global economy is slowly migrating away from a unipolar financial standard and fracturing into a multi-currency settlement network. Weaponizing the SWIFT network yielded immediate tactical victories for the US, but it permanently compromised the perceived neutrality of the dollar system. The era of absolute American financial hegemony will not collapse overnight from a market crash or a military confrontation. It is being slowly, methodically overwritten by the quiet adoption of alternative code.